Okay, well, I have a couple minutes after 12, and we have a lot of content that we want to share. So I'm just going to go ahead and get started. I'm sure a few more people are going to be coming in, but let me just first start by saying thank you. First, I wanted to say a thank you and shout out to Buckalter. There's a sponsorship for this Lunch and Learn, as well as sponsoring all my previous pub talks and webinars. So big shout out to Buckalter. And for those of you who don't know me, I'm Laura Kubitschek. So I am the venture catalyst for the West Metro region up here in Portland, in the general Portland area, Washington County. And I'm also a statewide coordinator for the Venture Catalyst Network. And I'm very excited for this particular Lunch and Learn that several of my colleagues are joining me for that. So let me introduce Deanne Buck, who's the Venture Catalyst for Central Oregon. So Deanne, do you want to say hi and maybe say a few words?
Absolutely. Thank you, Laura, and welcome everyone. I am the Venture Catalyst Director for Central Oregon. I work under EDCO, which is Economic Development for Central Oregon, and work in partnership with both Laura and Mike to help elevate and accelerate entrepreneurship in the state of Oregon. And I'll say a couple of assets that we have that we utilize to really help support entrepreneurship are our monthly pub talks and the Ben Venture Conference. And you're going to meet one of our panelists today who is the fund manager for the Ben Venture Conference. And so for every entrepreneur who's on here, I just want to put that on your calendar. It's every October, and we'll be opening applications in June and July. And so you can put all of what you're learning to practice. Thank you, Laura.
Thank you, Deanne, and great to have you. And now I'd like to introduce Mike White, who's a venture catalyst for Mid-Valley. And we definitely want to give Mike a shout out. He's surviving on only 4 hours of sleep because he's a brand new father to a beautiful baby girl. So welcome, Mike. And do you want to say a few words?
Yeah, no, thank you so much for having me. I'm here, spectating and supporting this great Lunch and Learn. My name is Mike White, Mid-Valley Venture Catalyst. I'm another entrepreneur and individual that loves to help other entrepreneurs grow and connect them to resources. We founded the Mid-Valley Angel Fund about 3 years ago, where we have a small group of angels that love to seed fund startups, not only in our area, but throughout the state of Oregon. And Paul Jensen is one of those investors, another great advocate for startups. And we also are going to be doing the food and beverage boot camp this summer. So focusing on grocery, food and beverage entrepreneurs, getting them to the next level, the end of August. And that we're doing that in conjunction with Angel Oregon, the Oregon Entrepreneurs Food and Beverage Conference that's coming to Salem this year as well. So just a lot of fun activities that are going on in my neck of the woods. Thanks for having me.
Yeah, thank you, Mike. Thanks for joining us. Okay, so just the agenda for today. So I have a quick PowerPoint to go through. I'm only going to spend 10 minutes on it, so I'm going to go pretty quickly, but I just want to lay the groundwork for what the panelists are going to be talking about right afterwards. So let me just go ahead and get started with that. So the topic for today is business financing, or how to raise capital. There's probably, at a high level, there's 3 different ways you can raise capital for your business. One is through grants, second one through a business loan, through a bank. CDFIs are commercial development financial institutions. Oh, community development financial institutions. Sorry, too many acronyms out there. And the other one is equity. What we're going to focus the webinar today is specifically on loans, SBA loans, and equity through angels or venture funds. What we won't cover today are grants, and I really appreciate so many people that are listening in today submitting questions, but we're not going to cover grants. We're not going to cover crowdfunding. That might be a topic for a separate webinar. People had also asked about raising capital for nonprofits. We're not going to cover that. That's typically through grants or sponsorships. And we're not going to go over the specifics of a term sheets, though that has been a topic in previous webinars, and we might do that later. Okay, so business loans, there's typically, and so again, this is high level, making general statements. When you go for a loan, they're going to look at your credit scores and how much money you're making, the years you've been in business, what's the size of your industry, do you have a business plan, what's your goals for the business, of course, all sorts of financial documentation, but specifically, they're going to look for collateral or some sort of personal guarantee. And so Scott Bossum today is going to talk about SBA loans. There's a variety of SBA loans. I'm not going to go into it. Scott is really the expert in this area, so I'm going to let him cover that. Again, I just wanted to let you know there's different loans out there, so hopefully we can help provide a little bit education on that. And then when it comes to equity financing, that's typically used by startups for a variety of reasons. One, they don't have any collateral. Two, they're just starting their business, so they really don't have the revenues, the cash flow coming in. And three, they're typically a very high risk profile, and banks typically don't like companies with a high risk profile. I think what's important for everyone to know, with an equity investor, they're going to give you money for your business, but in return, they're going to take a part ownership stake in your company. So it's important that people understand that if they're looking for angel investors or going after venture funds, that they're going to become part owners in your company. And equity investments are typically higher risk. Again, these startups are higher risk profiles, so they're going to look for higher returns than if you were just going to get a loan through the bank. One of the things I like to share whenever I'm talking about financing is talk about the funding ladder, because as I talk to entrepreneurs, they typically want to skip rungs in the funding ladder and immediately, for example, go ask for money to help them start their business or to validate what's going on in the market. And typically, funding doesn't work that way. What investors are expecting is in the exploration phase of your business, that you're going to likely self-fund that. And that's either through your own money or putting, charging to credit cards, etc. Then once you have your concept, you need to go out there and validate it in the market. And then that typically requires raising some money. So again, either you can self-fund that, you can go to friends and family, perhaps depending on what industry you're in, there might be grants to enable you to commercialize or to validate that in the market. And then as you start to build your business, then you can look at things like crowdfunding, angel funds, seed venture funds, and then it goes from there. But I think it's important to realize that investors are going to want to see that you have some skin in the game, that you have invested your money, maybe your family's money, and before they invest money into you. And our panelists are going to go into it a little bit more, but again, I just wanted to at a high level say this is typically the process you need to follow when you're talking about getting funding. Angel investors, real quick, are typically high net worth individuals that are going to give you money, going to give you capital for your business. In return, you'll give them convertible note, which is actually a debt instrument, because at early stage in starting a company, it's hard to value your company before you get out there and start selling some product. So it's typically a debt instrument that converts into equity 18 or 24 months down the road. Angels can either invest on their own, or Paul is an example of being part of an angel group, and he'll talk about that. But they expect to hold this for typically less than 10 years, and then they're looking to get their money back. And that means the company either has an exit of some sort, they're bought. Typically, companies these days really don't have too many IPOs, and typically you're bought by somebody else in the industry. And then venture capital firms, so those are professionally managed venture capital firms. They'll get their money from a variety of resources. So they're going to give you money for your business. In exchange for that, they get private equity stake in your business. And typically they step in when you're looking to commercialize or accelerate the market acceptance of your product or service that you're offering. They normally do not fund startups at the very, very beginning, but Jen can talk about that a little bit, because I know, I see her nodding. As part of the Portland Seed Fund, sometimes they will get some pre-seed money to folks to get them started. And with that, real quick overview, I'm going to turn it over to our moderator, Ernie Bootsma from Buchalter, and Ernie's going to introduce our panelists. So thank you, Ernie.
Thank you, Laura. Good afternoon, everyone. So I'm Ernie Bootsma. I'm a shareholder with Buchalter. We're a law firm with offices all through the West, including Portland and Seattle. I've been working with startups for 25 plus years, maybe 30 now, working on everything from funding to formation and intellectual property matters. So today we've got a great panel. We've got people with different experiences. So first up is Scott Bosom. He's an SBA loan expert. And then we've got Paul Jensen, who works with the Mid-Valley Seed Fund. And also Jen Lynch, who Laura has talked about, Jennifer Lynch, sorry, who is actually working at the Venn Venture Fund and at the Portland Seed Fund with several of their funds. So we've got great panelists with good experience kind of covering the topics that we've just outlined. So I'm going to turn it over maybe to you guys to introduce yourselves a little further. Go ahead, Laura.
Yeah, sorry. I forgot to, but before I turned it over to you, I wanted to, because tell everybody I really appreciate it. A lot of you submitted questions. Ernie and I have tried to incorporate that into what we're going to do with the panel this afternoon. If you have additional questions, if you could please put it in the chat room, I'll monitor the chat room. And we have time at the end of this event to have a Q&A session. So thank you.
Thank you, Laura. All right, why don't we go ahead and Scott, have each of you introduce yourself just briefly, and we'll kick this off. Scott, why don't you
go ahead? Yeah, you bet. Absolutely. Yeah, thank you. Nice to be here. Scott Bosom. So I've been in banking finance for about 30 years. About half of that in the SBA world. I used to work for the SBA district office in Portland. Most recently ran the SBA department at Columbia Bank, and taking some time off right now and looking for my next opportunity. So, but happy to be here. I'll be talking in more details about SBA loans and how they could be a source of capital for you. So appreciate it.
Scott, Paul, why don't you tell us about yourself?
Sure. I spent the first part of my career in sales and sales management in the industrial automation sector. Started a company that we did electronics, custom electronics for OEM equipment builders. Sold that company and went to work for the acquiring company where I retired as the president of the industrial automation business. During that part of my career, we did 9 acquisitions to continue to expand our portfolio. And so I've been on both sides of the fence. So it's kind of my retirement project of working with Mike White to build out the Mid-Valley Angel Group and try to really enable entrepreneurs in the Mid-Valley.
Well, Jennifer? You're on mute.
Hi, everybody. My name is Jen Lynch. I am a partner at Portland Seed Fund, which is an early stage venture capital fund based in Portland, Oregon. We are sector agnostic and prefer to focus on pre-seed, seed, and A deals. And we invest in companies based in the Pacific Northwest primarily. I'm also the managing partner at the Bend Venture Conference Funds, which is an angel group that invests once a year in companies who are interested in exhibiting at the annual Bend Venture Conference here in Bend, Oregon, each October.
Jennifer. Well, let's kick this off and maybe talk about the topic of timing. I think all of you could probably address that issue of, when does an entrepreneur or an early stage company want to come speak with you about either SBA loans or equity investment from your various funds? And like, maybe we'll start with you again, Scott. How do people, when do they start?
Yeah, so the reality is SBA loans can actually work for startups. You have to find the right kind of lender that's willing to lend to startups. There's a lot of banks that won't, for instance, but there's a lot of non-bank lenders that will. You do have to be ready to launch. So you cannot get any SBA funding to be when you're still in that kind of research phase and proving the product or the service or whatever it is that you're doing. So that cannot be funded by SBA, but you can have no historical revenue and get an SBA loan. So really it's talking to somebody in the SBA. You could go to the district office, you could connect with an SBA department at a bank, and they'll help direct you from there as to whether or not they can do it. And maybe there's another lender that's maybe a better fit.
Thank you, Scott. How about Paul and Jennifer? One of you can take it. Maybe sort of when do you get, what sort of stage do you see people?
Well, I thought I really like Laura's slide on the steps because, the people we are talking to, and at least by the time they get to a pitch, Mike's probably screened a few out that weren't ready yet, but they have launched. They've probably done a little validation of the concept, and now they're looking for some money, whether it's just for inventory or to do a little marketing or whatever it might be to expand their business and get to the next level. I think maybe we've talked with one person who hadn't really validated, hadn't gotten there yet. But they had a pretty good story. So in general, it's right where you say it's somebody's got an idea, they've proven it out, and they've put together a business plan, and they're ready to start rolling.
Paul, Jennifer?
I'll say that we at Portland Seed Fund, we do not look at companies that are pre-revenue. So they have to be, they have to have a product and they have to be actually selling something. The exception that we make is companies that have generated grant funding. So a company that has made it through a large grant process, we look at that as kind of a revenue line. That's somebody who has proven their technology to the point where a funder is willing to, is willing to put some gas into that engine. And those are sort of the only pre-revenue companies that we'll look at. It's in general because they are working on a technology that is so complex that the company may exit or sell before it actually is in market and selling product. And so an example might be a drug company. Those often change hands before they are fully in market, fully FDA approved. And so as an investor, we can take a look at those a little bit earlier than we would a software company.
Thank you. Well, let's talk a little bit about the kinds of companies that maybe what attributes that you guys are looking for. So in other words, we'll flip the same thing around. Once these right stages come to see you, what are you looking for? What attributes do you see in these companies that you need to see for your particular investment? We can maybe start with you, Jennifer, and go back the
Yeah,
other way.
I'll go first. So I think what I usually counsel of folks when they are talking to a venture capital fund is to look really closely at what that venture capital fund is looking for in a portfolio company. The vast majority of them will tell you exactly what they are looking for in a portfolio company on their website. And if not, then you can use resources like Crunchbase or or other sorts of databases in order to get a feel for what sorts of companies that fund invests in. And the reason why it's important to take that extra time to research what the fund invests in is because you have to remember that the fund raised money from investors. So the fund is not, we are not individuals investing our own money to a great extent. We are investing money on behalf of other people, and we have told them what we're going to invest in. So at Portland Seed Fund, we said to folks, we're going to invest in about 50 companies. We're going to write a small initial check. These companies are going to be at pre-seed, seed, or A stage. When we write that first check, we want them to be based in the Pacific Northwest. We'd like them to be capital efficient with high growth potential. We're not looking at single location retail. In general, we don't write checks into food, like blah, 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 right? Like, so we were very clear with our investors what we were going to invest their money in. And so as such, those are the sorts of companies that we are going to take a serious look at when they come to us. So if you are raising money for a thing that doesn't fit with it's called the fund thesis, which is, how we describe what we're going to invest in, then you're automatically not going to be a fit. And it's not a great, we've already sort of decided long before we saw your company that we weren't investing in companies like yours, and therefore you're probably not a fit. So when I see companies who express interest in raising money from Portland Seed Fund and they're based in, in Europe, or honestly, like there are, they're just sort of very basic. That first level of research is super important in order to make sure that you as an entrepreneur are not wasting your time reaching out to venture funds. And then once we do get a look at them, we look at the same things that that most venture funds are looking for, depending on the scale or stage at which they invest. Because we invest pre-seed, the team is extremely important to us. These are, you're probably not generating a whole lot of revenue, and you certainly aren't, in sort of a finally fully fleshed out team. Obviously, you've got a smaller team than you will have once you raise money in order to hire people. So the folks who are at the table are very important to us. When I say team, is one person a team? They are not. So we're looking for more than one person. We like to see that, that there is a team in place. We're looking for evidence of traction. So are people saying that that the product is getting a little bit of a foothold? We're looking at the product itself. Does it have a competitive advantage? Is it a good product? Does it move the ball forward? In general, we don't invest in things that don't move the ball forward. I saw we once were pitched by a website that did nothing except refer you to a divorce attorney. You just typed in your address, sent you a divorce attorney. This is not a product that kind of moves the ball forward, right? Like, this is not a good example of something that Portland Seed Fund would invest in, because in general, we're looking for good products that have sort of a meaningful space in the market. We're looking for proof. So do you have some kind of evidence that the product works in the way that you say that it does? We love it when that comes from customers. And then your ability to pitch. So we know that we are not going to be the last check that you receive from any investor. And I want to make sure that if we put our money in, then you still have the ability to raise money from additional folks further down the line. That's what's going to give you that sort of accelerant into the engine. So I always counsel folks to just walk it through. If you have a team, is there traction? Do you have a good product? What's the proof of the product, and what's your pitch?
Thank you. That was very enlightening. Paul, maybe talk a little bit about your fund. Do you have a different approach to what you're looking for?
Sure. Well, I think the first thing to point out is that, because, as Mike said, we're only 3 years old, we're still evolving. So we do not have the level of sophistication that the Portland Seed Fund has to this date. One thing that is different about the Mid-Valley Fund is we are not grouping the money and then redistributing out to investments. Each angel gets to decide on every opportunity whether they want to participate. So it's a little bit different business model from that perspective. The general criteria, do you have the good team? Do you have a viable product? Have you proved it's a viable product? That all of those things are absolutely true. As far as having that really tight thesis for the fund on what we will invest in and not, we're actually kind of in the process of tightening that and developing it. We do invest in food companies, not necessarily restaurants, but food companies, because it's the Mid-Willamette Valley. And if you don't, you're cutting out half your market. So it's, so I think those would be the differences. Just, not as evolved, and we are investing individually into companies, not as a group.
Suppose that can be an advantage at times, because then each individual might have their own criteria. And so again, maybe back to Jen's point, that's a good way to you need to understand who you're speaking to, what fund, and how do they approach things. Because
Yes.
again, maybe there's an individual in a group like yours, Paul, that will have more interest than others. So
Yep.
All right, let's move on to SBA loans. Maybe Scott, you could talk to us a little bit about, from a banker's perspective, when does the company become bankable, and what sort of criteria? I know Laura mentioned a few things, but let's elucidate on that a little more.
Yeah, definitely. So, a lot of SBA is about eligibility. So I'll first mention, there are some types of businesses that are not eligible for SBA. Nonprofits aren't, because marijuana is still federally illegal. SBA is a federal agency. No business that's tied to marijuana is eligible. So you have things like that. I mean, generally speaking, most types of businesses, most industries are eligible. Some of the ones that you commonly see in SBA are retail, higher risk industries like restaurants and construction companies, trucking companies. And then generally speaking, a lot of the businesses that are getting SBA loans have collateral challenges. And that certainly fits a lot of startups. And that would be the other most common reason that businesses are looking for an SBA loan when they're newer, less than 2 years in business. Maybe they've got a little bit of traction, but you got to hit 2 years before a bank will not consider you new. So that's kind of the magic, number there. We're looking more at the numbers, right? So and for a startup that, that's going to be projected numbers. So we do look really closely at what you think you're going to do. We look really closely at the assumptions that you're putting together around those projections. And then one other thing I'll say with newer companies, the ones that are going to work, because there's a lot of startups that you won't be able to find an SBA loan for. And there's a variety of reasons there. One of the most common ones would be if there is absolutely no other household income. So a spouse that is continuing to work. A lot of people that are starting a business are going to keep their day job, type thing. So if there's external income outside of the business that's not reliant on what the business does, that's very, very helpful for a bank, for a traditional lender. And that could even be, not, a non-family or somebody that's willing to be a guarantor on the loan, and maybe they're a minority owner in the company in exchange for kind of putting up their financial strength personally. So I think I'll stop. I'll leave that one there.
All right, thank you, Scott.
Yep.
Let's talk a little bit about process. So in other words, you've now had somebody who's made an application to you. How long before they hear back, or how long does the process take to actually closing a deal and making some, bringing in some money to the company? And again, everyone's process might be a little different. Why don't we start with you again, Scott? What's the typical loan, and then we'll work back across.
Yeah, definitely. So, first let's say SBA loans can be wide ranging. So they could literally be as small as $5,000 and they go up to $5 million. So really, really wide range. Obviously most of the newer company, most, startups, less than a couple of years, Those are going to be smaller size loans in a lot of cases. You know, so the timing will depend a little bit on the size of the loan. For instance, when I was at Columbia, we had a $5,000 to $25,000 product that was fully scored. It did require a year and a half in business. But if you hit that threshold and you met the score, you could literally be approved in a couple days and have money within a week or so. You know, most SBA loans, though, are going to require a full application. You're going to be providing personal information, personal financial statement, taxes, everything in between. And the process is going to generally be 60 to 90 days from when you provide that completed loan application to when you're closing and funding. It can be quicker than that, certainly, and that would be more on the smaller deal side. Business acquisitions, deals where you're buying another company, we do a lot of that in SBA. Those are going to be the ones that take the longest amount of time, especially the larger ones. You probably be more towards that 90-day period. But one thing I'll mention, and just in addition with that, is, you know, be on top of it, because a lot of that delay, we build in time waiting on answers to questions. We need additional information. Sometimes that can take 30, 60 days for you to get, you know, answers to questions and things back. So as quick as you guys, if you're talking to a bank, if you're looking at an SBA loan, you get asked questions, just be on top of it. Because that's also gives a really good impression to that lender too, that you are on top of things, and when you're responsive like that.
Paul, how about you guys' process? And I suppose the same would apply to you, that, you know, you want people to stay on top of things and reply to diligence questions and so forth.
Yeah, absolutely. In essence, you know, somebody might reach out to Mike White, you know, somewhere early in the process. Mike will work with them, kind of do an initial screen, or maybe he'll have one of us get involved in that process. Eventually, you know, they get invited to come to a group and pitch. And we immediately, right after that meeting, we all sign up and say, I'm interested, I'm not interested, how much am I willing to go in for? And once that's done, it can happen very quickly. I think there was I'll call it a smaller investment that only took a couple of weeks after the pitch, and maybe 3 or 4 weeks, but it, you know, wasn't drawn out. We've had others, just because it was complicated and larger and a lot more pieces, that, you know, can go on for quite a while back and forth. You know, you give them the note, the convertible note that was our typical tool. They take it to their attorneys of course want to mark it up, and then you go back and forth on that process. So that can take a while. So it kind of depends on the magnitude of the deal. Probably the most time in our process is just getting all the way to do the pitch in front of the investors. That process.
And how about yourself?
So at Portland Seed Fund, like a lot of venture capital funds, we're hoping to sort of shortcut the process by receiving introductions about companies from trusted referrers. You know, and that's my strongest recommendation to anyone who's hoping to raise venture capital, is to find, you know, somebody who's in the partners network. And, you know, at Portland Seed Fund, we work really hard to make sure that network is really big. We've invested in 160 companies over the last 10 years. That's a whole lot of CEOs that you may know or have a connection to. We've worked with every law firm in Portland and most of the ones in Seattle. The law firm with which we're housed is also based in the Bay Area. That's another way that folks get introduced to us. We strongly recommend that folks make use of state resources available to them, and I'll kind of expand the loop and say that your venture catalysts are also great trusted advisors and referrers to us. And so all of those are ways that we hope to get introduced to companies, as opposed to receiving cold emails, of which we receive quite literally at least a dozen a day. And, it's very hard to sort of cut through the noise without that kind of warm introduction. After that, the process varies. It can take up to 6 months for us to make a decision on a company. If it's a founding team that is entirely new to us, and or a sector or, sort of product that's entirely new to us, we may want to stretch it out such that we can see evidence that you're doing the things that you said you were going to do. So we meet you in June, you say next quarter, we're going to be, going to market, and, and we're going to be launching in this new city, or we've got this new product in our product line coming out, then we will hang out for a quarter and see if you actually get it done. That actual evidence of progress is really important to us, especially when it's a new founder or a new team to us. And if you have a round that's going already and folks have already committed to invest on the terms that you're putting in front of us, that usually speeds things up for us. That means that that somebody has already taken a look at the deal and decided that the price is right, the valuation is right, and and those decisions are easier for us to make than when we're starting entirely from scratch. So I'll say, we can go as fast as you want. We actually do move really quickly, I think, compared to many other options. But if it's entirely new and we're starting completely from zero, then I would expect it to take at least a quarter, if not 2.
So it seems like most of the investors I've met, they say they like to meet people earlier, even if they're not ready for investment. Sometimes
Yeah.
just building that connection is important.
Super true. And we always encourage, if an investor gives you time, so they take a meeting with you and allow you to do your pitch, that is, you start building an email list, and those people need to get an update from you. Ideally once a month, once a quarter is fine too. But if that investor has taken the time to meet with you and they haven't said, like, you're never going to be a fit for us, we just don't invest in this sector, et cetera, et cetera, et cetera, then you should keep them in the loop, keep them updated. They are probably not going to reach back out to you to see how you are doing, because again, they're juggling dozens of deals at a time. And so take it upon yourself to demonstrate that you are making progress.
Let's shift gears again. Let's talk a little bit about size. Maybe when we get to loans, we can talk about kind of the scope of loans. I think, Scott, you did touch on that, but maybe Jen and Paul talk a little bit more about size of deals that you guys do. And again, maybe even a little bit about structure, how you go about the process.
I'll answer really quickly because it's pretty straightforward. Portland Seed Fund writes an initial check that's about $100,000. Sometimes it's more. But in general, between $100,000 and $200,000, that's our initial check. Over time, we do increase our investment in companies. We on average over the last 10 years have invested in our portfolio companies an average of 2.5 times. So we know that when we write you a first check, we're probably going to write you a second, and oftentimes a third, sometimes a fourth, in order to help get you to that place where you have sustainability. And again, it's extremely specific to every single venture fund. That's another thing that you should probably research as you're sort of considering who to approach.
So Mid-Valley is could be as small as 5,000. I think most of them, and Mike could verify this, are between 5 and 25,000. But we've kind of said we would go as high as 200 if there was interest in the investor group to be able to collectively put that kind of an investment in place. Our mechanism is virtually always a convertible note. I think that's probably going to be pretty common for seed funds versus or angel funds, I should say, versus venture capitalists who are probably going to be more oriented towards equity investments.
Scott, how about to you? How about loan size? Kind of what do you see?
Yeah, like as I mentioned earlier, it really wide range. So $5,000, $5 million. But to give you an idea, most active SBA lenders. So at Columbia, we did the most SBA loans in Oregon and Washington. We would do about 350 to 375 SBA loans a year throughout those two markets. And our average loan size was in the 150 to a couple 100,000 range. And we did we did $5,000 ones, and we did $5 million ones, and really everything in between. But you do see the majority fall, really the majority probably fall in the less than $1 million. And SBA has been really trying to streamline and make smaller loans easier for lenders to do, to open those doors up more. So you definitely see, like from when I worked for the agency, 6, 7, 8 years ago to today, there's far more small loans, and there's more non-bank lenders that participate in SBA. So CDFI, Certified Development, our Community Development Financial Institution, those are nonprofit type lenders. They do micro loans all day long, so $1,000, very, very small loans. They'll average in the $10,000 range, and they're a great option for startups that don't need a lot of money. They just need to launch on a really small scale and kind of start selling and proving what they've got, but they're revenue ready. So you can get SBA funding if you're ready to sell and generate whatever you're doing.
Thanks, Scott.
Yep.
So let's talk a little bit about when an entrepreneur comes to each of you, what do you see are some of the big mistakes that you often see that might harm someone when they want to pitch to you? So we want to help the audience now kind of understand things that they should be doing to prepare and things they should avoid. Any thoughts on that? We can start again with any of you, whoever wants to take that topic first.
Sure, I can jump in, because it's this is actually something that it's an interesting thought process. You're asking someone to invest in your company, right? And it's an investment. So the investors want to know, and it's kind of cold-hearted, but really, what's in it for us? There is this whole thing where, we're the Mid-Valley Angel Fund. We are trying to promote economic development in the Mid-Willamette Valley. And that is an important element to everything that we look at. But in the end, if you come in and you show us a business plan that you don't know how you're going to pay back the loan, or if you even can, or what the revenue streams are going to be like, that's going to be a quick turn off. It's just, it's a little bit of the cold-hearted business side of it, but it's the reality. You have to see, we had one pitch where the gentleman tried to tell us his business was worth $2 million and wanted us to buy 10% of his company for $1 million. And that's a math problem, right? So vet those things out and make sure it's clear what you're asking for, what you're going to use it for, and what the end result of doing that gets created. What's the result that's going to allow that investment to be worth us taking the time to put the money in?
I'll jump in as well here and just kind of echo the comments there. It's very similar. It's a loan, so still an investment. A lender, we just want the money. We want the principal back, and then the interest, that you agree to pay. So it's very heavily focused on how are you going to generate the revenue and the income to pay the loan back. And so literally the first thing that any SBA lender will do, especially if they're looking at a newer business and they've got a business plan, is they're going to go right to the back, and they're going to look at the financials. We're going to look at the numbers, and more importantly, we're going to look at the assumptions to those projections. How did you develop those numbers? Where do they come from? How did you, are they reasonable? And I always tell the story of a yogurt shop. I worked for a very small bank here in Portland 10, 15 years ago. Startup yogurt shop, back when frozen yogurt was like all the rage. And I go to the projections, and it was the same revenue and the same expenses every single month throughout the entire year. Well, obviously it's a seasonal business, being what they were doing. And right away it was like, okay, there wasn't a whole lot of work done and research and thought into what are those cash flows really going to look like? and they're all projections. So we all know they're not going to actually happen the way that you think they're going to happen. The idea is to make us as the lender comfortable that it reasonably could happen, or you're going to be close. Because what we'll do is chop off 50% of your revenue, or we'll make your cost of goods sold go up by 1/3, or we'll do things to shock the numbers. And if we think they're reasonable and then we shock them and we're still good from a cash flow standpoint, those are the types of situations that an SBA bank lender will be able to possibly do, a startup situation that will possibly be able to do.
Jen, I saw you shaking your head earlier. Do you have some other thoughts about some of these pitfalls?
Yeah, I mean, I think so. Back to the beginning again, like a huge pitfall is coming in with a company that's not a fit for what the fund invests in, whether that's style, stage, geography, sector. Like there's just a lot that, you know, again, like, and that's for your benefit as well as for the funds. That just makes for a much more efficient process for everybody. If you're talking about the, you know, sort of the right fit for the fund. And then the second is remembering that, you know, there are not a lot of investors who invest in business ideas. They invest in businesses, you know? So we get a lot of folks who come with a great idea for a business and are frustrated when, you know, they don't have folks lining up to write checks. And in general, a lot of us have ideas for businesses, right? Like that is that is something that a lot of people carry around in their head, and turning the idea into something that is actually incorporated, has a co-founder, again, is generating revenue. Like these are all really big, important steps that are critical for an investor writing that first check. I mean, and the asterisk is, of course, there are venture capital ecosystems that are very different, where you can sort of walk in with a misspelled PowerPoint. And I'm looking at you, Adam Newman, and say, hey, I've got this great idea for a business. And, you know, because you have had, you know, extraordinary success with a prior venture, or because your network is made up of folks who are deep pocketed and have unlimited risk tolerance, like those folks are the chosen few who can raise money with a business idea. But for the rest of us mortals, having an actual business is kind of that most important ingredient.
Well, talking about ingredients, it's interesting. Several of you mentioned, you know, you look for the team, and I assume the same is true on the loan side. But are there certain things that you look for in the team or the people? I mean, what are those intangible things that you look for when you're going to make an investment? We can start with you, Jen, first, and go back across again.
Yeah, I can go. We again are looking for expertise in the space in which you're coming to us with a business. So, you know, you're an engineer and you're coming to us with a cookie company. We want to know, you know, where it is that you're going to get the expertise to make the cookie company successful, right? So we want to, just like any job interview, we're looking for relevant work experience that will well position you to make good decisions with the money that we're about to give to you. And then we also, like I said, we are looking for a team. You know, it's hard when we get a solo founder, someone who has not, we just in general, we don't write those checks. We are looking for folks who are sharing equity in the business already on paper with somebody else. Part of that is because, you know, again, you are going to have to hire, and hiring folks for a startup is not the same as hiring them to work at Microsoft or, you know, at Intel. Like, it's going to be sketchy. You may or may not, you know, be in business 9 months from now. You need to be able to convince other people that this company is worth investing their time and their limited sort of resume capital in. And if you can't even do that with a single person, then you're not ready to ask for money from a venture capital fund. It's too early. You know, you just have to sort of find that first follower. In order to show us that you're going to be capable of hiring additional people once you move things further down the road. And then, we like to see leadership experience. I mean, not everybody has been a CEO before. That's totally fine. But can you demonstrate to us that you have hired, managed, run operations? Again, we and other people will be trusting you with a giant pile of money, and you're expected to start managing. And we want to understand what suits you to doing that, beyond just having sort of a great idea for a product. And you would too, right? If it was your money and you were loaning it to someone, you would want to make sure that they were, that they were going to be responsible with it. And this is just us doing our job to make sure that that's true of the CEOs in which we invest.
Thoughts on that, Paul?
Sure. I have yet to meet an entrepreneur that did not have an incredible amount of passion for what they were doing. And so that's important. It has to be there. But it pretty much is always there. So the next piece to kind of mirrors what Jennifer said, which is, where is the evidence or the background or the skill set that they can turn their passion into an actual business? The leadership, the management, or their willingness to go out and be resourceful and find help when they need it, and knowing where to go look and find that help, and just that whole commitment and persistence to what it really takes to build a business. I often will refer people to go read Phil Knight's book, Shoe Dog. You want to read a book on what it takes to start and grow a business, that's it. That's what it takes. And so it's a little bit nebulous to try and identify, it's not just passion. Are you willing to do what you have to do in the moment to keep it going and to keep growing your business? And little hard to identify, but it's you can push and you can kind of get there with people.
Scott, you think other attributes that lenders are looking for?
Not really much different than that, honestly. It's very, very similar. You can be a startup and not, get an SBA loan and not have ran another business. So you don't have to have that prior business ownership, but very, very similar to what Jen and Paul both said. It's where's the experience? Is it industry experience? Those are tough. Somebody that works for a tech company that now wants to start a bakery, that kind of thing is those can be tough. But if you have a co-owner, so like what Jen was saying, if there's somebody else that's involved and they've been in the bakery industry and you're coming together to do it, and you've got some good money from that tech job or, wherever you worked, then those can kind of work. So you can kind of see how, it is very, very similar to what the equity side, the venture capital side, investor side is looking at. And it is very hard. I'll echo Jen, and just lastly, where the sole, trying to get an SBA loan for a startup when you're the sole owner, and there's no other household income, and that's it. You don't work elsewhere. It's that business. There's no other partner there. Those are really tough. Those are really hard to get bank and potentially even SBA lending from a CDFI. Some of those can work. The very, very small ones, those are more in the microloan world. But those can be tough for the SBA side too.
Thank you all. We're about 4 or 5 minutes away from the top of the hour. One thing I wanted to touch on is maybe how you guys, each of you, in making your investments or your loans, how do you expect to get paid back? I think that is helpful to a lot of entrepreneurs if they understand how investors think about their return. And so maybe if each of you could cover that for a few minutes, and then we'll take a few questions. One.
Yep. I'll just jump back in. I'm just real quick. So ours is, there's a rate. So SBA loans, the rates are capped. So SBA doesn't allow really, really high rates. They are tied to prime. So most SBA loans are in the 2% range over prime, give or take. It can range, it'd be much lower than that for a real estate deal, maybe a little higher for a smaller deal, that kind of stuff. But generally in that 2 over prime. That's a tough rate right now. It's 10.25 because prime has jumped quite a bit in the last 18, 24 months. So rates are much higher in SBA. Fees on larger loans can be larger. Fees are waived right now on smaller SBA loans. They have for actually pre-COVID, so that's still going on. So you have some SBA loans that aren't going to cost you anything from a fee standpoint. And then lastly, most of your terms of SBA loans, non-real estate, are going to be 10 years. So they're much longer than a conventional loan. Most of the stuff that SBA lends on would be 3 or 4 year term if it was a conventional loan. So they're much longer. That keeps the monthly payment as low as possible. Real estate can go out to 25 years if you're using SBA for real estate. And those are fully amortized loans. There are no in conventional, you'll get a lot of loans where it's a 5-year term, but a 25-year amortization. So you have a big balloon payment that you actually have to go refinance in 5 years when you get to that balloon payment, because nobody can make that big, huge payment. SBA doesn't allow that. So if you get an SBA loan and you make your last payment, you're done. You're at zero. It's going to fully amortize. So you don't have structures that require you to have to go get a new loan to, again, refinance that balloon payment.
Ours are pretty straightforward. They're all convertible notes. I think they're typically 2 years. When interest rates were lower, all those notes were 8%. We've talked about we need to be a little higher than that in today's environment. We haven't done anything with that. The convertible note gets, if there is prior to the 2 years, if there is an equity event or a qualified equity event, then there's a conversion formula that we have the option of participating in, or we can say, no, we just want our money back. Tends to be not a lot of conditions. It's pretty straightforward note. If the end of the 2 years, there's some formulas and mechanisms that we also could convert to equity if we so choose. And if the borrower or the company wants to pay back, they can basically write to us and say, we'd like to pay you back with interest, and then we can either say yes or no to that. So that's the simple structure.
Thanks, Paul. Yeah.
Yeah, it's exactly the same. The investment terms in which we put on money are going to dictate how we get our money back. So like Paul said, with convertible notes, in general, we are not looking to get paid back. We are hoping that that note converts into equity upon a subsequent funding round. And in general, we write notes that say that you are unable to prepay them and you cannot just sort of pay us back and buy us out without our mutual agreement. So we're taking a huge risk by investing super early. And part of our reward for that is that we get to stay part of the company as it grows. In general, Portland Seed Fund gets our money out when the company sells, when it goes public, or when there is a very large funding round led by a very strong investor, and someone sort of puts their thumb on us and says, we would like you to sell some of your equity or all of your equity in order to make room for this future funder. That's the sort of the edge case. But in general, when the company sells,
Quick comment that I didn't make. The value of the convertible note, especially in early funding, is you're not having this discussion on how much the company is worth, right? So when you're a company and all you've done is validated, you have a product, you've started to generate a little revenue, and then you want to tell us you're worth, X and we think you're worth Y, And now you get stuck in this whole valuation thing about what actually might happen with the company or not happen. So with a convertible note, it just takes all that off the table. There's just no discussion about what's the company worth. It's you get this amount of money with interest, and later on, when you get into a discussion about the value of the company, that's when the conversion now takes place at a later date when there's more better established value for the business.
Very important concept. I think getting people to understand, again, they have to be in that path for selling or going in an IPO. Otherwise, most investors are not going to be interested. It's sort of that base criteria. Laura, we're at 1:02. Are there any questions that we've gotten that we would try to address, or?
Yeah, I have a couple things. There's been several questions asked about contact information. And so I was going to address that at the end, but I'll mention it right now. So to everybody that has registered for this event, what I'm going to do is send you a link to the video if you want to look at it later, or share it with someone. I'll do that. And so you'll have my contact info. I will also share the contact info for the Venture Catalyst. And what I would suggest, a lot of people want the contact information for the panelists, to be fair to them and so that they don't get inundated. I would ask that you send that request through the Venture Catalyst. We all know these people, and we're not trying to, prevent you from reaching out to people, but we do like to, get you prepped. I think anytime you have, want an introduction or want a meeting with someone because you're raising capital, it's always good to go through the Venture Catalyst just to make sure you're prepared for that conversation. So that would be my suggestion, and I will send you all of our contact information when I send out the link to this video, so or to this webinar. And one question that popped up that I would love to have everybody address is they're wondering how the raising capital landscape has changed in the last 5 years. And then in essence, looking into your, experience crystal ball, how do you expect raising capital might change in the next 5 years? So if we could go around the horn and hear everybody's comments, that would be great.
I just have one that's fairly obvious, I think, but it probably needs to be said. The period of super low interest rates is over, and it's probably going to be over for a while. If we do indeed have a recession and they choose to reduce interest rates to stimulate the economy, I think the past 10, 15 years of artificial low rates to continually stimulate the economy, that I think those days are just over. So I don't expect to get really cheap loans and really cheap money for several years to come.
Good advice. Jen, you want to go next?
The last sort of like major revolution in our world was the introduction of the SAFE, and at this point, that's been probably about 5 years. I think it's possible that some novel form of investment term or instrument for early stage investors will come up. So I would sort of be on the lookout for that. We continue to be interested in the ability of the crowdfunding platforms to get traction. This is, of course, a new SEC designation that allowed non-accredited accredited investors to invest in early stage companies. We have yet to sort of have our first unicorn that started its life on Republic or on WeFunder. Hasn't happened yet, totally could happen. And I think if, once there's one really big success that comes off of one of those crowdfunder platforms, my hope is that we'll see those start to take off for early stage companies. And then, the last is that, great companies do tend to be started in times of recession. So our best performing fund at Portland Seed Fund, we started writing checks in 2013. That was after we were coming out of a 2-year recession. If you think about the companies that were started, they sort of showed up at our door sort of in year 2 or year 3 of their fundraise. That fund is performing enormously well. And so 5 years from now, I expect to see, companies that have been started in this kind of whatever it is that we're in right now, that's not a recession. We're not supposed to say that R word, but whatever this is, I do expect sort of companies that are started in this time of economic uncertainty be really hitting their stride 5 years from now. I think it's going to be awesome.
Excellent. Thanks. All right, Scott.
Yeah, there's definitely been a rise in the last few years of kind of online lenders. You'll also hear them referred to as fintechs. And some of them are okay. There's a ton of them did not do any kind of SBA lending, but they participated in PPP when we went through COVID. Some of you guys, I'm sure have, PPP. I have PPP TSD today because of going through that 24 months of craziness. But you had a lot of the fintechs jumped into that PPP program, and now they're trying to continue that and do additional business lending. Some are okay. The pitfall is a lot of them can be very bad loan structures. And so it's just kind of watching out and making sure you're not just running on your own and doing that, getting counsel from people like Laura and the Venture Catalyst and or anybody that runs in these circles to just make sure that you're not getting into something that you shouldn't be. A lot of people go that direction because they don't have to sit in front of somebody. It's kind of faceless and you can apply online and it seems easier. And maybe it is, but the consequences, you can get a really bad loan structure that could be a problem for you in the business. And kind of what, on the outlook, SBA SBA lending is really very recession or economy proof, meaning in great economies, you have a lot of maybe more people that are starting businesses or looking for capital to grow their businesses. So SBA is a big part of that. But then in an economy that's maybe not so good, you have banks and other lenders look to use SBA more because they want more protection on the lending they're doing in a riskier economic environment. So I think not discounting SBA, it's not a fit for every newer business. But I think there are a lot of newer businesses that discount the bank lending side. Like, well, I'm a startup, I'm new, I could never get that. That door is there. And so it's just making sure you get to that SBA, whatever bank you're talking to, just make sure you get to the SBA department. And you might find, a path. And if not, you'll find a good next step that they'll help you make as well.
Great, thanks. And I apologize if there's background noise. My printer just decided it's gonna clean itself right at this moment. But I have one last question. We only have a couple of minutes left. Jen, I'm gonna direct it at you, and Ernie, you can chime in if you want to add some. But a couple people, Jen, you mentioned safes, and it's not entirely clear in people's minds what's a safe versus standard convertible note. And then someone just asked about a promissory note. So I wonder if you could comment on those.
Yeah, so a promissory note is a convertible note in general. I mean, that's, we would not look at something that doesn't have a provision to convert to equity. So, if it's any other kind of a note, then that's a loan. That's different. That's not that's not an investment term. That's a loan. And I've answered a couple of them in the chat there, but I strongly recommend Brad Feld and Jason Mendelson's book. It's called Venture Deals. He spends a lot of time explaining convertible notes and does it from the perspective of the entrepreneur, and also explains what the investor is looking for. So the reason why I like that book is because it's not just sort of a dry, legal recitation of how the instrument works. It's more like, this is what this means for your business in the future when you do really well. This is what you're gonna, expect to sort of get out of it. And this is what the investor is gonna get out of it. And that's really, it does a great job of putting these into business terms, because fundamentally that's what you as the entrepreneur need to understand. But the short version is a SAFE is just a smaller, shorter version of a convertible note that doesn't have an interest rate. Both of them just sort of say, like, this is how much the investment is that's going into the company. SAFEs tend not to have sort of maturity dates and interest rates in the way that a convertible note does, but both note and SAFE, express an amount of an investment that's going into a company and a future valuation at which that investment would convert into equity. We at Portland Seed Fund, and that sort of that future equity number, that future valuation number, that is called the cap of the note or the SAFE. At Portland Seed Fund, we don't invest in uncapped notes or SAFEs. Other investors may do something different, but that is our rule. We only invest in things that sort of, that have a cap and a valuation cap. And again, the SAFE is just sort of an invention of Y Combinator, like circa 2017, 2018, just a cheaper, faster way of getting a convertible note done. It was their, goal to make it sort of like faster and easier for all parties. And they definitely introduced some, some founder-friendly provisions with that instrument, which in general, we are supportive of. We obviously very much like it when the founder does well. As a result of the hard work that they put in. So Venture Deals, go read the book. I put a full title in the chat there.
Oh, you did? Okay, because I was just gonna ask that. So I made a copy too. Jen has been doing a great job of answering a lot of questions along the way. So I think I captured that. So when I send that email out with the link to this recording, I'll include all the answers to the questions that were in the Q&A. And again, I just want to thank Ernie and Scott, Paul, and Jen. This has just been a fantastic webinar. Great insights from all of you, just in terms of the challenges, but also the positive sides of raising capital. So really appreciate your time and thank you again.